What's up, everybody? Tom here with another video. Well, it seems like everything's red in the markets right now, and of course that was a bit of a brutal start to the week. We've got big news with non-farm payrolls coming out. We've got a lot of concerns, but really should we be cutting through that and finding some optimism and hope moving forward? In today's video, we'll try to be answering some of the key levels that you should be looking at in the SP 500, Nasdaq, Tesla, Apple, and some others right now. Following the leader is generally the best thing to do. Stay tuned. All right, guys. Well, here begins our market recap for the markets closed 4th of October 2021 in the US. And straight away, we're taking a look here at the heat map of the S&P 500 to get a bit of an understanding of what did happen in the markets. It was led by the FANG, biotech also clearly down, and utilities and energy and the defensives were clearly the ones or the parts of the market that were looking a lot better. We had technologies such as Microsoft, Apple, Google, Facebook, with Facebook also going down and crashing throughout the day, I believe, and Amazon all really moving much, much lower. Tesla was strong off those good numbers, and it went above 800 at one point. Imagine if it had closed there. It would have been phenomenal. We'll talk about that soon. So let's take a look at what actually happened through the Monday session, and it went down straight away. So there wasn't really too much trapping from Wall Street. They just sold it straight away, pushed it right down, got around 2.5% down, as low on the Nasdaq as it could go, and it hovered there for the rest of the session with a slight pickup in the all-important SPX into the close. And we'll talk about why that's important and really something we should be looking at. When we have a look at the sectors, you'll notice utilities, a defensive sector, also consumer staples, defensive sector, and energy were the best, and technology and biotech, those growth areas, were the worst, consistent with what you would expect Wall Street to be doing. So let's move into the SPX and the SPY, and we'll actually start here on the SPY, the S&P 500. And I want to bring this one up because we're going to be looking at the options and the flow and where we have the put walls and the call walls in just a few seconds. I think new time subscribers and people that are coming to the channel will really enjoy this analysis because it's super important stuff that you need to be doing in these markets. And the markets closed basically marginal. So what we mean by that is they closed right around the point where you would expect buyers to be there, which is that 428 or 430, 4300 area on the SPX. So notice that was the previous low, it's the low again, and then it's basically where it hits off and it goes again. So when you're looking at this market, you think, well, is this really bearish? Yes, the market is bearish at this stage. Is this a very strong bearish close? Not really. It's like one of those points where between now and the next open, you could almost see the futures going up a little bit before Wall Street makes a decision whether it truly wants to move down to the next supports. And we'll talk about where they are soon. 2050 cross. Now, this is a very important moving average cross. 2050 exponential moving crosses don't happen very often. The last time we actually saw a cross was all the way at the start of the pandemic, where it crossed back up to the strong side here around May of 2020. So it doesn't happen that often, and it tends to lead to some people thinking that there's weakness in these markets. And I want to just explain why that may not be the case. So here it is underneath in terms of the 20 moving average currently this week. We know that when markets fall lower, they tend to go towards this 50 exponential moving average. This level here is usually where the bigger corrective dips get purchased. Imagine if we got down there. We detailed in our weekend video all about the 50. We detailed how many times it tends to come back to the 50. And if it ever closes underneath the 50, how that leads to a second leg. And we've only seen 2 of those legs other than the pandemic happen really all the way since 2011. So let's think about this. Where after the global financial crisis from 2011-12, we run into 50s as the biggest correction that you see throughout that entire time, except for twice. So it's very rare that a market will go underneath the 50 exponential moving average during a bullish cycle. And that's why it's such an important area to be looking at here on the SPY and the S&P 500. Because if we keep moving down here, let's say we get through the next supports we'll talk about in a second, and we move down to this level, do you think there'll be Wall Street sitting there buying the dip? Yes. Do I think a lot of retail traders would be freaking out completely if that occurred? Absolutely. And why? Because the market will be down around 10%. Now, historically, that's not that much. It's only down since May, May levels here and April levels of this year. But a lot of people will freak out here. And this is the point where Wall Street get that maximum amount of fear and then they turn it around. So always keep that in the back of your mind. From a technical analysis expectation as well, when I said 2050s don't matter that much on the S&P, let's go back and have a look at 2050s in the past. So we haven't had a cross here. We have a cross almost there. It doesn't go down. We have a cross here and it marginally stays lower. We have a cross here and it goes a little bit lower after the cross, not much. And then we go back to all the other crosses and only this one meant more. Of course, it got through the 50 back here. We go to another cross, very marginal, only a little bit lower. So what you'll notice is that in the last 5 crosses, only one other than the pandemic led to an actual really big further low. And that's why we don't take these moving averages crosses into consideration as much. We use them more as dynamic support and resistance areas. Let's now talk about the options though, because that's what really has got us interested this week. So we took a bit of a read from the weekend and we didn't have the same amount of data as we have now. Since the weekend, since Monday's opened, more people are going bearish on puts. And what this does is it creates what we call put walls. 420 has become the strike of choice for traders this week. So we have a put wall between 420 and a call wall at 440. Now you might be asking, Tom, what does this even mean? Or I've never even heard of these put wall, call walls before. It's the ideal area for Wall Street to basically trap or keep the range of the SPY in for the week. And this is an evolving situation, but it's something that we should use as traders and investors to get a bit of an understanding on where they might want to push the markets. Let's say they push the market weaker this week. What's going to happen? Huge amounts of puts are going to be opened all over these strikes. If they push it down to 420 at some point, what do we think is going to happen? Everyone's going to open these puts, and then ideally it becomes a put wall because Wall Street don't want to move it underneath this level. It's a good technical support anyway, which we've seen on the charts plenty of times. So yeah, ideally they have it in this area. At this stage, a perfect expiry would be around here, which is around that 423 on the SPY. That would be an absolute perfect zone at this stage early in the week for the expiration come Friday to make optimum amounts of money from the options. We also want to keep a bit of an eye on the biggest expiry of the October month, which is the 3rd week expiry. And this expiry shows us that we still have a huge amount of open interest at 450. This was one of the early indicators that we used to really kind of predict that the market was either going to go neutral during the period of August into September, or was going to go bearish. And that was that there was way too many options calls opened in advance at certain key zones. The FOMO or the euphoria of the market a few weeks ago was too high, and we expect that the market should stay below 450 ahead of the 15th of October, at least to get these expiries worthless. Still not too many puts open between these zones down here, but you can notice there is a lot more puts opened around these areas of 420, 405, 430 for the 15th of October versus the amount of calls. And the calls are really just absolutely exponentially high for the 450 strike. So now that we've had a look at the SP 500, we'll take a look at the QQQ, the Nasdaq soon, Tesla, Apple, and a few others. But I think biggest notable change of trade that we saw through the Monday session was US oil. US oil through the OPEC meeting where they said they would marginally increase barrels, basically smashed through the 77 market. And this is an important closure zone here for the daily. We kind of expect a little bit of weakness now to come back through, for it to come back down and test this 76, 77 low or high now as it is. Test that and then hopefully move higher. Now you're going to see a lot of articles being written about $100 oil and all sorts of things now that this oil has broken through here. But this is a super critical zone. If we go back in history, what you'll notice is it was support, 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 which became resistance during that 18 into 19 high, which is resistance again, which we expected earlier this year. We've been very good with oil here as a community together. And now that it's broken through, we're allowed to go to that next zone, the participation phase. Where's the next zone? Previous resistance, previous support around that 86 area. So oil is super interesting. It's certainly a trade that's going to have some ramping in it. I think because of the manipulation that goes on in oil, it's one of those things that they're going to allow it. OPEC will allow it to get to certain zones, and then they will crush the price based on them just increasing barrels and obviously wanting to make some money. They did get hurt by the pandemic very badly in the balance sheets in their countries, so they will want to increase barrel production in the future. Always keep that in the back of your mind. It's a manipulated, realistically, commodity. You've got to be aware of this. Let's move over to Tesla. So Tesla fans would have been super excited through the Monday session. I tell you what, it was looking fantastic. And if it wasn't for the fact that the day was actually bearish overall, I mean, the Nasdaq was down 2% plus, Tesla probably would have cracked 800 and closed higher. It did get through 800. It didn't close higher. If it had done so, we've talked about the 880 quite a few times. It's a very important area to be watching. And we also have that 762 as a key support. So 780, 760, 800, all zones to watch here on Tesla. But I particularly like 800 plus closure out, because once that occurs, we get into what we call a participation zone, and we really allow Tesla to ramp towards that 880. So I'll be watching 800. I've got alerts. I got an alert today for it, but it didn't close above. Good numbers coming out in terms of the amount of cars they've been able to deliver. They don't seem to have the supply issues many other manufacturers have, which is excellent. And yeah, the vehicles are flowing out. And I can tell you here where I am in Australia, there's plenty of Teslas being bought by millennials and realistically everybody. They're always sold out here as well. Let's move over to the 4 hour. And I just want to quickly show you here the 4 hour 50. That's also been an interesting moving average. Should it come down, hit it with that 760. Again, 4 hour has been bought up a few times, and we have that longer term trend line for Tesla. Let's take a look at the options for Tesla as well. Nothing much to note here. A little bit of calls being opened around the 700 strike for the week, expiring again Friday the 8th. We have 800. We've got a bit of a call wall here. If we allow the stock to go through 800, that would be really fantastic, because that would show a huge amount of ramping of call options. And far and away, people are super bearish on Tesla. I've mentioned how this is not the way that you want to be looking at it. The price action's been bullish in recent weeks, and everyone's been bearish on it from an options side. Now, it could be Michael Burry. I don't know who it is, but whoever's been doing this has just been basically burning cash, because every week they've been putting these huge amounts of puts in the market around 700, 720, 740, 760, and all of them have been expiring worthless. So I'm not sure who this is. It could be some large retail traders. I don't know. But yeah, going negative against a price action strong chart is not what I would call the smartest play in the book. Let's move over to following the leader. So we've been talking about Apple here for quite a while, and the daily closed super marginal. Basically, I wanted it to get underneath this pin bar, this rejection hammer. It closed right on it. Is this still a negative style candle? Yes. Is this the type of candle that you look for to show further weakness for for Apple here? Yes, it is. And we hope that Apple can get down to this 135, 130 range where it hits our previous trend line and really hopefully bounces off this area. Right there is where we would like it, guys, if it could happen. This is what we call a marginal close. Some people may have scaled into shorts here. We have the 2050 cross to the downside fully in play, which is again consistent with the SP 500 readings we had before. And if we move down to something like the 2 hour, what you'll notice is that even the trend line down is kind of holding in place. Now, if you're going to go bullish on a pair like this, I don't know if that's the best price, what happened today. I feel like you're in the middle of nowhere land and we expect further weakness. So following the leader here with Apple, if Apple continues to weaken, we move down to that 135, we find the previous trend line, the previous resistance, and this should be a very key point in the market. So when we hit this, we're probably hitting like a 420 on the SPY. That's going to be the zone where I believe a lot of bulls will come back into the market, and it'll be super interesting to watch. Another reason I believe that it kind of deserves to be down here a little bit, Apple, is just the incredible amount of overall calls that have been opened on Apple in the last week. You'll notice anywhere from 140 strikes to 160 strikes are all net bullish. So the red bars, obviously they're more puts than calls, but overall they are net bullish positions. And that means that if we were expiring positions down here in that 135 this week, or even between 130 and 140, we would be making optimum money from a Wall Street perspective. If 70% of all options expire worthless, it's just something to keep in mind. And look at how many calls are still opened on this stock. Almost unbelievable when you think about the price action again. Let's move over to the QQQ. So if this was a weekly close, which we're on right now, I would say yes, incredibly bearish. Let's move towards this 342 on the QQQ, or maybe even the 50 exponential moving average on the weekly. It isn't a weekly close, so we need to go down to the daily. And we need to understand that where the Nasdaq closed was basically the next level of support. After we got through 360, we always expected for it to get down to this area. Now, just like the SP 500, which is on 4,300, we expect it to kind of be a little bit of buying, a little bit of purchasing. This is where the buyers are going to try to buy that dip. And if we close back underneath here, where do we go next? 342, and that should be the low that I expect here for the QQQ. I've been talking about this zone for a while. Even if you look at, like, let's say the trend line on the Nasdaq that we've been following, around this level here makes perfect sense. This 342 is previous resistance, very solid resistance, and a daily 200 moving average, and the bottom of the trend line. It just makes a lot of sense that this zone here is what Wall Street will be looking at and will be gunning for in this correction. Also, if we measure the percentages, we're actually at that perfect spot. We just hit 8% down. And we always talk about 8 to 12% down, or 8 to 10 as being a standard correction period. If you look at all the previous corrections that we've had since the pandemic, if you actually take all the Nasdaq corrections, this one is about 12, 13%, pretty large actually. This one over here is about 10%, pretty normal. This one over here is about 12%, again, pretty normal. And then this one over here is around 8%. The smaller side. So between 8 and let's call it 12% is usually where a standard correction ends and bulls pick it back up. And I think you want to keep these stats in the back of your mind. If you bought between 8 and 12% from an investment standpoint, obviously make your own decisions. I can't tell you what to do. This is only educational stuff. But these kind of zones are what investors, what Wall Street looks for, and they play these stats regardless of all the information you hear, regardless of the fear, the FUD, all these types of things. That's the stats in a bull market. And if you believe we're in a cyclical multi-year bull market here, it's something to be watching for. Here's the NDX, just to give you the same levels, and you'll notice again that level is 14,000 on the NDX. They look slightly different, the QQQ and the NDX, just because of the nature of what they are. But overall, this zone here I could see get tapped, then a reversal, and we stay within our beautiful channel as well. So this is how it looks, ascending channel. Be phenomenal if it kind of holds around this area here. And we're certainly in that buy territory for some dip purchases. Let's have a look at Bitcoin now. So Bitcoin consolidating, but broken out. And this was a big close for it. It's a big point here for Bitcoin. And this should hopefully lead to bullishness across the cryptocurrencies. Effectively, all cryptocurrencies are down. And this is traditional what we see happen when Bitcoin goes strong. So Bitcoin goes strong, all the money flows into Bitcoin, all the hype and the FOMO's in that. It then stabilizes at its new level. And then we see a move into Ethereum. And then we see a rotation into the other coins and then the smaller alts. So it's a big closure here happening. The 4 hour has already closed above this previous resistance. And now the 8 hour and 2 hours and 36 minutes from the time of this recording will close above this area. Once that happens, we move towards the next levels. The next levels are 50,000 and the level after that is of course 52K. So Bitcoin poised here for some serious nice movement. It's had a great base, and all of a sudden, all that fear that was in the markets come out of it. I will put a preface on this. If the US 500 gets underneath 4,300 and it does start to crash or starts to correct back down to that 42 or 4,050 area, this market will come with it to a degree. We've seen cryptocurrency, once the S&P starts, going past that 5%, 6% correction level, sometimes get involved and go weak when the S&P is going weak. So just keep that in the back of your mind, but overall, very strong price action here from this. Another thing that makes it so strong is the BTC shorts are so small. I mean, this is real price market action with no whale manipulation from the shorting side. Look at this. No increase in shorts as it's been going up. Nothing like what we saw in the June manipulation here or the July manipulation. So another strong signal that there is some strength here in the crypto markets moving forward. One thing I also want to remind everybody of is that if you're feeling fear right now, if you go and have a look at the stats, sometimes you can take comfort in that. We had a 7-month long win streak of S&P 500 gains each month. September, of course, backed in a first month of weakness. But if you come back in 6 months' time, statistically, from all of these previous big win streaks, you'll notice only one is actually down from that point. Almost all of them are up, and an average is 92.9% towards that 8% positive. So statistics are telling us that while you could be fearful right now, realistically, the stats are on your side towards the bull side. And we know that when it comes to these dip levels. There's always a good reason, but then is the reason going to come to fruition? Of the big news that we're waiting for, and these are really going to trigger market corrections or further corrections, we've got ISM PMI 10 a.m. Tuesday. I doubt that's that important, but it is coming out here for the US. And then if we scroll down here, the big bit of news is non-farm employment change. That's coming out on Friday, 8:30 a.m. New York time. And I would say this is the big catalyst here. If this is a weak number or the market doesn't like it for whatever reason, it could be that thing that gets the weekly through, pushes us down to maybe a 400, a 420 on the SPY, and maybe a 4,000 even, or a 405. So a 405 or a 420 could be happening off a catalyst from these non-farm employment changes. So there's a lot of foot here in the markets. Be careful, be nimble, be quick. And if you enjoy this video, guys, please remember to subscribe. And of course, smash that like button. It does help us out. Are you a bull or a bear this week? Put it in the comments down below. Bye for now.